All right, thanks. Good afternoon, everyone. We'll get started in a minute, but before we do, there's a bit of housekeeping that needs to be done. Firstly, the toilets are out to my left and your right. And secondly, in the unlikely event of an emergency, there's 3 exit doors behind you. Please go out the doors. There will be marshals. Follow them out, and they will lead you to a safe assembly point. And now to get started, my name is Buingotlo, and I'm going to be your program director for the day. I'd like to welcome you all again to this MPF. It's the first one of the year, so really quite exciting. The purpose of us being here today is really for the MPC and the SARB to take you through recent economic developments and how they've shaped their view of policy over the last couple of months, how they've influenced the interest rate decisions that they've made, and I guess importantly, how they've influenced the policy stance that we are now facing. Just to remind you, we've had 3 MPC decisions since the last Monetary Policy Forum, so I'm pretty sure that you're all very eager to see how the views of the committee have evolved since then. Before I hand over to the Governor, just one more thing. There's going to be an opportunity for you to ask questions after the presentations and after the Governor has spoken. For those of you who are in the room, there's going to be a roaming mic, so you just need to raise your hand, and then we'll give you the mic and you can ask questions. And for those of you who are joining us online, you can post your questions. We're monitoring all social platforms, and I will then direct your question to the Governor on your behalf. Without wasting any further time, I would like to now hand over to our Governor, Lesetjo Kganyago, to officially open today's MPF.
Thank you very much, Buingotlo. Good afternoon and welcome to the first Monetary Policy Forum for 2024. Let me take this opportunity to apologize on behalf of Deputy Governor Chasivana. I had to send her somewhere, so you are stuck with me. She is on bank duty out of the country. Let me also welcome the 2 new members of the MPC to their first Monetary Policy Forum. David Fowkes, is an advisor to the governors. He's been in the bank, but it's the first time he attends the MPF as a member of the Monetary Policy Committee. And then new kid on the block, Deputy Governor Mampho Modise, who also joins the Monetary Policy Committee. She's also attending her first Monetary Policy Forum, and it's only her 3rd week in the Reserve Bank. So please be kind with her with questions. It's now 2 years since the world has come out of the COVID-19 pandemic. Or have we come out of COVID? It might no longer be a pandemic, but it is still very much with us. Lives and economic activity across the world have broadly returned to normal. However, some of the pandemic's aftermaths remain with us. Since we last met in October 2023, the main challenges confronting the global economy have not changed much. Suffice to say that many of the risks that we had identified are beginning to materialize. Importantly, inflation, which was seen as a huge policy challenge of the day at the time, at least for central banks, is very much still with us. It remains the overarching policy challenge today. Monetary authorities globally continue their efforts to bring inflation down and within targets. So inflation is turning out to have been stickier or more persistent than central banks initially thought, unless you are from Latin America, where central banks moved earlier and have been able to rein in inflation quicker than many central banks. As the Monetary Policy Committee, we remain resolute in fulfilling our primary mandate to maintain price stability in the interest of balance and sustainable growth. Our policy actions will always seek to anchor inflation and inflation expectations at or closer to the midpoint of our target band. The MPR is a very rich document in analysis and sets out the various challenges that we had to deal with as the MPC, and captures more than just the normal statement that you normally receive when we finish the MPC. I'm going to ask Dr. Chris Lowald, who is the head of research and the chief economist, to also take you through the presentation. He has got quite a number of slides. Don't get scared. He will go through the slides fairly quickly. And is Fundi now with us? She is supposed to be online. She is online. Thank you very much. Okay, so that means that there are more people to answer questions than I initially thought. Chris.
Thank you, Governor. Of course, you should be slightly scared, because the temptation one always has is to subject you to about 100, 150 slides, but I have tried to avoid doing that this time around. I will go through it quickly. As usual, a lot of what I have to say is stuff that you will know from watching the news and reading the papers on a regular basis, and listening to a lot of what we have to say over time. So let me just start something here. There we go. Okay, so what do I want to talk about today? First of all, now I've got to get my clickers here. I'm going to go through a bit of a story about global disinflation and why it's become more uncertain and why inflation targets look elusive. I'm going to talk about policy rate cuts and how they're being pushed back and scaled down with some of the implications of that. I'm going to talk a little bit about global growth and why it's better in 2023, but it's not particularly robust, and it's also diverging, which is a topic I won't go into in much length, but we might want to talk about later because it's interesting. Sorry, I'm trying to chew gum and talk at the same time. I have a clicker on the one hand and a button on the other. So what's happening in the global economy is essentially that global demand is fading a bit, and that's impacting on South Africa. As you'll see, domestic demand has remained a bit more sustained. Supply constraints continue to weigh on the country, as you will all be well aware. And these together create ongoing macro imbalances, which generate persistence in inflation, among other things. Monetary policy is, of course, working to get to the target, but that's moving a bit slower than we would like it to do. Inflation is sticky, as you'll see from some of the charts, and risks remain persistent. I'm not going to get this right. There we go. Okay. So, here we go. Despite some moderation, the fight against inflation really isn't over. This graph just shows you global inflation over time. And the point to take away from here is just that those red dots are the International Monetary Fund's inflation forecasts for global inflation for 2024 and 2025. And the point here is that both of those dots still reside well above that dotted line, which is the long-term 2010 to 2019 average. So even though that blue line has come down pretty well, the forecast is still well above where central banks would like it to be. Inflation inertia is a big part of the problem. That headline inflation spike that we saw, the blue lines replicated here in the blue columns. And as I noted, it's coming down, but it's translating or spilling over into core CPI, which is the black line, and services price inflation, which is the red line. And you can see that these remain still well above headline inflation. They're coming down, but they're not coming down nearly as fast, and that is a cause for concern. Part of the problem is that wage growth remains quite elevated across advanced economies. This graph just shows you a wage tracker, so these are year-on-year growth rates in nominal wages across a series of advanced economies, the UK, Eurozone, US, and Canada. Some economies, of course, are doing better than others. You can see that the US economy wages have come down to somewhere around 3.5%, but if you look at the UK, they're still sitting up at around 6%. Canada is also sitting at about 4%, and the Eurozone too is around 4%, and these are not considered to be consistent growth rates with an inflation target of 2%. Core pressures remain elevated in emerging markets also, again for the same kinds of reasons. The spike in goods inflation that we saw in 2022 and 2023 continues to spill over into services price inflation. Now this graph is chart's a bit hard to read, but it's broken down into emerging Asia on the left, Latin America in the middle, and then other emerging markets on the right-hand side. Then each column is a time frame, so it starts at 2015 to 2019 on the left, and then ends with the month of December 2023 on the right-hand side. And the thing to take away from each of these groupings of countries is simply that while headline inflation is still quite high, the components are moving around. And food and energy, which is the green, is coming out of the numbers, but core goods is the blue. That's pushed those numbers up very strongly in 2022 and 2023, right in the middle there. And then the red is the services, and so it's spilling over into services price inflation. Like in advanced economies, emerging markets are having the same kind of inflation dynamic. So targets remain elusive given this rather poor inflation outcomes that we're seeing. This chart just gives you, for a range of countries, the September 2023 forecast for inflation. Those are the yellow columns. And then the latest forecast is the red dot. And then the black line for each, I need to move on, thank you. David leaned forward, which helped remind me that I'm way behind, sorry. Thank you, David.
Looking for the red dots.
Oh, you were looking for red dots, excellent. Yeah, keep up the good work. So the black lines are the central bank inflation targets. And you know, the point, just to take away from this without getting into any more detail than that, is simply that the September 2023 forecasts are not terribly different from the latest forecasts, those red dots, and still well above inflation targets for many of these countries. I'm getting the clicker right here, slowly but surely. Rate cuts as a result of this sticky inflation, persistent inflation outlook were very optimistic at one point in time, but they've been pushed back and scaled down. This chart just shows you the US, the UK, and the Eurozone, and the dotted lines are showing you what the markets expected the interest rate policy trajectory to be as of March of 2023, and you can see that the solid lines are well above those much more optimistic rate projections that the market had at that time. So those solid blue, red, and green lines sit considerably above the dotted lines. So this raises the interesting question, are positive real rates there? Sure, that's quite easy to measure. But are they doing their job, and are they tight enough? So do we have policy settings tight enough to actually get inflation down to where we want it to be? Again, a fairly complicated chart. I think the thing to take away here, above all else, is just simply that those triangles, those green and black triangles, show you that real rates sit at what look like relatively high levels, again, across a range of countries. The blue columns are just the intervals around estimates of neutral real rates for the different countries. So why might real rates not be as high as they ought to be? Well, one way of looking at it is to take a view of global demand and supply. You all know, of course, that the world has seen during the pandemic a series of really large shocks. These indices that we've used are just really proxies for global demand and supply. And the point that we're trying to make here is just simply that if you look at the start of the pandemic, 2020, running through to the beginning of 2023, that blue line, which is the proxy for demand, is way above the red line. So you had a very strong global demand impetus coming from a wide range of countries, monetary policy, fiscal policy, but supply response was extremely weak, and that's that red response. So for several years in a row, you get demand running well above supply. Some of that demand came from fiscal deficits. This graph just shows you what those fiscal deficits have looked like over time. The green deficit lines are columns are 2023. The blue circles are 2024. And then the red is the 2015 to 2019 average. And you can see that both for 2023, the green, and for blue, 2024, these fiscal deficits are well above those longer-term averages. So fiscal deficits are generally considerably larger than pre-crisis, and post-crisis, for many countries, they also remain quite a lot higher. Another reason for why inflation has been a bit more persistent is that we tend to measure things like Phillips curves over time, so the relationship between slack in the economy and the inflation rate. And as many of you will be aware, in the run-up to the pandemic, the literature and the analysts were all saying, well, the inflation, the Phillips curves for many countries has flattened, and the nicest way to see that is the left-hand chart, which shows you the US wage Phillips curve. And it basically meant that at various kinds of unemployment rates or vacancy ratio levels, it didn't seem like inflation was going to take off. But the blue line shifts up to the left after August 2020, and so the Phillips curve takes on a rather different demeanor and a different shape to it. And so it's less clear that unemployment is going to continue to put downward pressure on inflation. In fact, what this is saying is quite the reverse, that even at unemployment rates, you're getting a small movements in unemployment rates, you're getting inflation rising above, and you get a similar kind of dynamic for South Africa shown in the right-hand graph. So all of this is leading to some comment about what has actually happened to global growth. This graph is just trying to show you that while global growth remains below long-term trends, and the long-term trends are those dotted black lines. On the left, it's the global economy. In the middle, it's the advanced economies. And on the right, emerging market and developing economies. But the point to take away from this is that over the past year, the estimations of global growth and growth in each of these components has changed. So we started with the green line, April 2022. This is the World Economic Outlook. And it was expected that growth would be relatively robust. As we saw inflation persist and policy rates were going to stay high, those blue lines we shifted down to the blue lines, so global growth was expected to fall quite a lot. But we ended up in the red line, so somewhere between the two, somewhat better growth outcomes than had been expected. So the analysis of inflation and its relationship to growth and its relationship to policy has been moving around quite a lot. So let me move on to South Africa now. For SA, of course, we sit with continued weak growth and inflation pressures. They remain. This graph just shows you this going back to 2010 over a long time frame. The dotted lines show you our forecast going forward. So on the right-hand side for 2024 and 2025, we expect headline inflation in blue to continue to moderate, and we expect real GDP to start to pick up. Part of the challenge, of course, in our environment has been the low potential, continues to drag the real output growth down with it. We've talked many times about our estimates for potential growth and why they're lower, and I'll show you yet again why that's the case just now. But again, over a long period of time, this is quite a nice indication of the correlation between the supply potential of the economy, the potential growth rate in blue, and what has actually happened with real GDP. So of course, logistics and electricity continue to set the speed limit for the economy. I don't think we need to rehash this data. We talk about it all the time. I suppose the one thing to take away is just on that right-hand graph, the point that while load shedding has been much, much better in 2024, the red line, relative to the blue line, which is 2023, it's still considerably higher than it has been in previous years, and therefore continues to weigh on growth. Sluggish growth in real incomes also, of course, feeds through to sluggish demand in the economy, so partly contributing to that weak real GDP growth rate. Another factor feeding into those growth rates is terms of trade. Commodity prices are considerably lower, eroding what we had seen during the pandemic as essentially a windfall income gain to the economy. I'm just breaking this down into dollar terms and rand terms, and you can see on both measures these have climbed down quite precipitously over the past year. 2023, we fell by about 25%. 2023, 11%, and 2024 is meant to be about 5%. So those gains are dissipating. There have been some improvements in energy supply, and the team are trying to figure out how to pencil these in, get better data to improve our growth outlook and the outlook for potential growth. This is one kind of view of it. It sets off Eskom's energy availability factor, which is the green line, which goes down to the right as the factor declines, against NERSA's data on cumulative generation capacity that has been registered, measured on the left-hand side, as well as Eskom's estimate of the maximum installed rooftop solar capacity. Both those red and blue numbers are very large. They add up to roughly 15 gigawatts of electricity. The open question is how much of that is on stream at any point in time, but it does seem to be playing a stronger role than we've seen up to now in offsetting that decline in Eskom's electricity availability factor from its own generation units. That has lifted potential growth, and of course we want to see that going up a lot more than it has. This chart just shows you what our potential GDP growth estimates have been revised by since November 2022, which is in green, where it was relatively high, and then it's come down in the March meeting to the red, and now by the March 2023 meeting, and the March 2024 meeting in blue is slightly higher, and you can see how that plays itself out over the forecast period. Demand is back to its longer-term trajectories. The big movements in the columns in the middle of that graph, of course, are the very outsized responses to GDP caused by the pandemic and the pandemic's aftermath. The point really to take away from this is that those right-hand columns on the right-hand side are kind of back where we were prior to the pandemic. So we're looking at a growth rate that sits at somewhere around 1.5%, 2%. With low real GDP growth, even that low level of demand continues to sustain the twin deficits. So this graph just breaks down our investment financing over time. It shows you general government savings or dissavings, which is that green columns that fall to the bottom, and against corporate savings, which is the red positive line, and then it nets out at the net foreign borrowing requirement, which is the blue. So the blue line above is actually the current account deficit. And as we go forward, we expect general government dissaving to remain roughly where it is. It falls a little bit. But as that terms of trade and weak growth rate continues to come through, corporate savings is likely to moderate a little bit, so those red columns are likely to shrink, and that net foreign borrowing requirement then rises. All of this reflects in a risk premium for the economy as a whole, which trends higher and contributes to rising borrowing costs, something that we've talked about many times before. Long-term government bonds is the blue line, and the risk premium, so the extra amount that investors want to invest in RAND assets, is the red line. Headline inflation still remains above the midpoint. Oops, need to move. So this graph just shows you what the long-term inflation trajectory actually looks like. I think it's quite interesting to see just how large that spike in 2022, 2023 was relative to the inflation profile that we've seen going back to 2010. It is well above it and is starting to moderate with quite a bit of volatility in the right-hand side, so the most recent period, and I'll break that down for you now. Oop, too many. Okay, as elsewhere, our non-core inflation is giving way to core and services inflation. So that headline inflation spike I showed you in the previous graph, this is a bit of a close-up of it, and it's primarily composed of food and fuel prices disinflating, and that's what I'm showing you on the left-hand graph. The right-hand chart is showing you core inflation components. And of course, as you know, for many times we've talked about how there can be spillovers from non-core to core, and this is what it looks like. You can see core goods rising, that's the yellow, and you can see the core inflation blue and the red services inflation picking up. They're relatively well behaved. South Africa's inflation trajectory has not been nearly as bad as many other economies, but we're still seeing that same kind of spillover trend feeding through. There is a bit of an extra push coming from the normalization of some of those services components. This chart is arguably one of my most confusing, to me anyway. It shows you services price inflation, which is that black dotted line over time. And if you look right on the far right-hand side, you can see services jump up. If we exclude medical components of services inflation, you get to a services inflation line that is the blue one, so it's considerably lower. And if you exclude housing from inflation, and housing has in recent times pulled down on the services price inflation basket, you get to that red line. So if you pull services out, you get a much more deteriorated and scary-looking services price inflation outcome, which is that red line on the right-hand side. Labor market pressures remain broadly neutral, despite a considerable headline shock to real incomes. On the left-hand chart, The shock that I'm talking about is that on the right-hand part of the left-hand chart, that red line is headline inflation rising well above the compensation of employees, and that constitutes a real income loss to households. And usually that kind of thing, alongside rising food inflation, will eventually translate into higher wage pressures. And the MPC, in its MPC statement, likes to flag the risk that comes from this because it can have quite a large impact on inflation going forward. As it happens, our unit labor cost forecast on the right-hand side remains fairly well behaved, so the risk of inflation rising higher isn't actually incorporated very strongly in our inflation forecast, in our unit labor cost forecast, and how it feeds through to inflation. So what does it look like again from a longer-term perspective? Clearly, we were surprised to the upside by inflation tilting up, and you can see that from the March 2021, that's the red line forecast for inflation, moving to March 2022, which is the yellow. You can see a very sharp jump up, and then we get up to the actual inflation rate, which is that black line, and then we start to see these things coming off, and the inflation forecasts themselves moderating going forward with iterative MPC meetings. So the green would be the March 2023, and then the blue is the March 2024. One of the things to take away from this is that there isn't much difference between the March 2023 and the March 2024. So inflation has remained relatively stable more recently and is quite stable in the forecast period. So where did we get things wrong? And of course, there's much more material in the MPR discussing this. Well, on balance, our forecast errors were to the downside. That's what the previous graph showed you. And most of the forecast error came from underestimating food price inflation, which is the blue component of this particular chart. So this breaks down the error in the forecast by component. So food is quite large, and the other substantial one there is core goods, which is the red. So we had more rand depreciation than we had expected, and that fed through into higher imported inflation, and we tended to underestimate that. And then as we move into 2022, we continue to get that food price inflation under forecasting, but we get a little bit more of a over-forecasting of services price inflation, which is that gray bar. And then as we move into 2023, things become, as I said, more stable, a little bit easier to forecast. So let me move into the last few slides now. The policy stance has moved to restrictive, I would say moderately restrictive. How effective is that policy stance? Going back to the earlier question I asked about, well, do we have the level right? I think the short answer for all of us has been, well, we're pretty happy with it. One way of looking at it is to just measure credit demand. It remains relatively modest. These are all credit demand aggregates for households on the left and corporates on the right chart in real level terms. And so you can see the real credit demand in 2020, 2021, 2022, quite volatile, but generally on a rising path. As we raised rates into 2022 and 2023, credit demand started to moderate, so monetary policy transmission appears to be working. Real corporate credit extension is a little bit different. It operates slightly different dynamics because of the pandemic. There was a very large increase in corporate borrowing in the 2020 period to basically provide additional funding for corporates should they need it. And so some of the decline that you see on the right-hand side of the right-hand chart comes from the need not to borrow anymore. But of course, part of it does also come from higher interest costs. When we look at more focused demand measures of inflation, so this is one of the innovations in the MPR is that we provide you with a new set of measures of core that we've come up with in recent times. You can see that all of these core measures actually remain relatively high. So the standard core measure is the green one, so that is just headline inflation excluding food and energy. And what you can see is it's subdued in recent times, again, because average housing inflation and medical insurance inflation has been quite low. If we look at the trim mean measure, that's the blue line, a lot more volatility there. The trim mean measure excludes components with the highest and lowest month-on-month percentage changes, 5% on either side. So you can take out a lot of the movement in food and fuel, but you still get quite a sharp rise in that trim mean measure. And the point about this is just simply that even if you take out some of the more volatile elements, there was greater dispersion of inflation pressures through other elements of the core measure. And then we provide a couple of newer measures, a principal component index, which is the red, that's the scariest looking, and then a super core measure, which is the yellow one. And these are constructed in different ways. You can get into the technical detail of how they work by reading the MPR and getting into that. But they all show a very similar kind of story, that even core inflation is sitting somewhere above 4.5%. There has been considerable moderation of food and fuel prices, which have helped bring down that headline inflation measure, as we've talked about. But we've also seen these risks start to resurface. Crude oil futures are on the right-hand side, and food is on the left-hand side. And this is just a very good reflection of the more parlous state of geopolitical and geoeconomic circumstances that we find ourselves in, that these exogenous prices are starting to rise again. Inflation expectations still remain pretty sticky and well above 4.5%. The BER survey is shown on the left-hand side. And we saw a very nice climb down in inflation expectations through 2020, through 2022, really, and then it picks back up again in 2023 and into 2024. And this is certainly of concern to the MPC and the way in which it thinks about the future inflation trajectory. On the right-hand side, we show a distribution of the 2-year ahead inflation expectations over time. And again, as the humps that you see there move to the right, moving from 2019 in green to 2023 in red, that suggests that inflation expectations are more dispersed and they're to the upside. There's nothing to conclude. Yeah. There you go. It's all done. Okay, so here's my last slide. As global domestic and price inflation proves sticky, that disinflation path and uncertainty persists. Again, for those of you who read the financial press every day, you will be well aware of what's going on out there and why, in part, this is the it'll work, don't worry. Thank you. I hope why that's the case. On the left-hand graph, the South Africa's forward rate agreement curve just shows you some sense of what the local market thinks about expectations for future inflation rates. And the point just to take away from this is that, again, it's moved quite a lot over time. The red is the December 2023, yellow is January 2024, so it's still relatively positive. But then by the end of February and the end of March, those rate expectations had climbed quite precipitously back up, again reflecting all the uncertainty out there. Okay, so let me just conclude. So we've talked a bit about why disinflation is slowing, a couple of different kind of analytical points here, one being that aggregate demand and aggregate supply are not very well matched. There are lagged effects impacting on them globally and domestically. We've seen that Phillips curves look like they're reverting to a much less benign inflation structure. And there's an ongoing question out there about, well, you know, is R-star too low? So do we have our policy settings at the right level to actually finish the job getting inflation back to target? Higher rates certainly look like they are going to last for longer. That, on balance, tends to lead to market volatility and emerging market weaknesses. Geo risks are certainly also resurfacing as low growth and food and fuel inflation play themselves out in global inflation. And demand measures of inflation continue to show inertia, and core remains sticky. Thank you very much.
Oh, no, I won't need that. Thank you. Thanks, Chris. It's that time now where you could pose questions. Please identify yourself and your affiliation, and then we will guide the MPC members to respond, starting with the newest one and ending with the oldest.
Yeah, Molefelengai from RNB. Governor, are you able to say what is your preference for the new inflation target level? There have been comments that it's 3% with a 1% band. And if this is indeed then the case, how soon would you like to achieve this level given the persistent services inflation that was highlighted in today's MPR? Thanks.
That remains for me to say is congratulations to you and the Deputy Governors on being reappointed. We're very glad to see stability at the Reserve Bank. That's what we need in South Africa at the moment. Thank you.
Thank you.
Sorry, Ed Sauter with the Daily Maverick. Thanks. On page 17 of your presentation, you've got a couple charts there showing the decline in the tonnage handled through ports and rail alongside a chart showing load shedding. I think they're quite stark. And I was just wondering, I know the bank has previously given forecasts about the impact on GDP growth from load shedding. I was wondering, do you have any estimates on how much the logistics crisis has caused GDP? Thank you very much.
Governor Azar Jameen, Chief Economist at Econometrics. I found it quite terrifying to see the one chart about budget balances over the past year. Is that not really the principal source of why inflation is sticky around the world and possibly in South Africa as well? And what are the ramifications thereof? Is there not a risk that we could find ourselves chasing after our own tails, pushing the can down the road, too scared to for governments to embark upon a contractionary fiscal policy to remedy this, and that in turn can keep real interest rates a lot higher for a lot longer than before? And I mean, the long-term prognosis is then quite bleak, not only for South Africa, but for the world as a whole.
Thank you. Azar, let's take one more.
Brian Scallon from the Da Vinci Business School. My question is related to the first question. It is widely recognized that inflation is a tax on the poor. Why is it that South Africa targets to tax its poor at 4.5%, but the developed world targets to tax its poor at only 2%.
Okay. Let's take these questions in turn. The first question about the preference for a new target. At the end of the day, a target to be credible, for a target to be credible, there must be buy-in. And that buy-in is very important, that it takes place from the two institutions that are responsible for macroeconomic management, that is the Treasury and the Reserve Bank. But experience have also shown us that if there is broad government and country buy-in, the disinflation task becomes easier. And so the work and the engagement that is taking place is between the Treasury and the Reserve Bank in the main, reviewing the target. The Treasury has already released the macro review. I know that I would make your job so much easier if I just give you a number. But I'm not going to give you a number. All I can tell you is that there is no theoretical or policy basis that the revision of the target will be higher. It can only go lower because that is what we have seen around the world. And those countries that we generally compare ourselves with, that we call peers, are now having narrower inflation target bands and are having lower targets. And so if we do not revise ours, we are going to lose competitiveness. It's as simple as that. But then this links up to Brian's question to say that why do you want to tax the poor more whilst the world is taxing them less? And it comes down to the case that has to be made that there is no virtue in high inflation. As you correctly point out, it is a tax, not just on the poor, but it's a stealth tax. It's a tax that you don't have deductions for it, Your personal income tax, you could have deductions for whatever allowance that you have. You do not have deductions with inflation, which then says that if you are to protect the poor, it goes without saying that you should be aiming to bring inflation lower. But by bringing inflation lower, you are also taking inflation out of the key decision-making processes because you are providing certainty to the investors that we know this is where inflation is anchored, and because of that, decisions are made much more easier. Which then takes me to the next question that was raised by Azar. I was in Washington at the IMF meetings, and I got to discover that IMF doesn't stand for International Monetary Fund. It stands for it's mostly fiscal. And so what had happened at the height of the pandemic was that both treasuries and central banks provided stimulus. And we all understood that the measures that we are taking are basically wartime measures. The world is faced with a pandemic. There is a big shock. We might have disagreed how much of the shock was demand and how much of the shock was supply, but there was a shock, and it knocked the economies. And so support had to be provided. As it so happens, when these things are provided, treasuries around the world will try and find a way of justifying why they should maintain the stimulus. And let me explain so that you could understand. There were some measures that were put loan guarantee schemes and all of that to try and support economic activity. When the great lockdown ended, many of those loan guarantee schemes were renamed. They got called startup schemes and all kinds of things. All of that was just simple way of saying politicians like stimulus, and when they have to take away the stimulus, they will find reason why the stimulus cannot be taken away. By contrast, central banks had provided support, and when inflation started to rear its ugly head, central banks started to act, and in the main, the early starters were the Latin American central banks. And whilst the emerging markets, once including this central bank, started to adjust policy because inflation was proving to be coming, and we were seeing that it was rising. The big debate in the advanced economies was the advanced economy central banks trying to convince themselves that inflation was not persistent but was actually transitory. Today, if you listen to them speak, they had moved from thinking inflation was transitory to saying that inflation is persistent. And recently, they have not just said it is persistent. They say it is proving to be more persistent than they initially thought, which is a code word of saying that rates are going to be high for longer. And that is what we face, and that is why we flagged that as one of the risks for emerging market economy. There was a specific question about slide number 17. I didn't present that slide, and I think it is only proper that the person who presented the slide answers the question. Chris?
Actually, I would like Theo, is he here, to answer that question? Theo, there he is. He's our head of forecasting, and I'm sure he can give you a better answer than I can.
So Theo made you say it.
He made me say it.
Thank you, Governor. So we've looked at the impacts of logistics. I can't recall there was a study done previously which came out with very high impacts, like, if I recall correctly, around 5% GDP impact. What we've done is we've looked at particularly mining output, because that sector is probably the one that's most affected by logistics. And we said, if you take mining, the different sub-sectors within mining, and you compare the maximum output before the logistic crisis really hit, or if that particular subsector had a trend growth rate, we extrapolated that going forward and said, if there wasn't a logistic crisis, what could that sector's or subsector's output would have been? So if we do that calculation, we got an answer of about 0.4% impact on GDP. Now you can multiply that maybe by, or double that, and say there's maybe some backward and forward linkages that's also impacted. So I would say the answer is probably somewhere between 0.5% and maybe 0.75% or so of GDP. And that's now over a period of more than 1 year. So obviously the impact from the logistics, as far as we can see, in terms of output, is much smaller than what the impact was from the load shedding per se. But obviously, prices-wise, that might be quite a different story in terms of how logistics is impacting price pressures in the economy. Thank you.
Thank you. Let's take more questions. As you can see, we employ very good economists. We'll give you a precise number with lots of caveats. And there's another one here.
Thanks, Governor. Mike Brown, ETFSA. two sort of nagging issues, so I'll ask them in one question and probably needs two answers. The first one is that release of 150 billion rand out of the contingency reserves into the Treasury to help with the budget deficit. Is that really just a balance sheet issue, or does that create any potential additional liquidity or anything like that that might require monetary policy action? And the second one is this grey listing, which is an exercise that I think every bank and even small financial service providers been heavily engaged in for some time. Is it possible to see from that, with all the data you get in the bank, any changes in the actions of the banks? Are they lending less or to different people? Is less money going offshore? Is there any way we can measure how that grey listing is impacting on the South African banking services? And does that require any monetary action? Thank you.
Good afternoon, Governor and team. My question goes back to the lower inflation target band. So I completely understand the rationale for having lower inflation. I personally welcome the reality. However, does this lead to the conclusion that we're headed for a reality of structurally higher interest rates? And my second question is that we've seen that administrative costs have been increasing at a pace that's faster than the inflation target. Are you, as the SARB, or would you at all be concerned about that, especially in a lower inflation targeting regime? And wouldn't that just make the SARB's job even harder?
James Vaughn from Billick Wealth here. Perhaps just a general question and a bit selfish, but inflation is real, inflation is sticky, as we've heard, and perhaps I could just ask from you, Governor, or from the committee for a comment or perhaps a statement of encouragement that we can take to the South African consumer as we're really struggling with inflation. Thank you.
Okay. Fundi, if you thought that there is a free lunch, try a free dinner. So you're going to deal with the grey listing. I think I'll give Rashad a break on GFECRA. David, you...
Governor?
you can deal with the GFECRA and the monetary policy implications thereof. And yeah. Yeah, we'll do. Let's start with you, David. Okay. Unless Mampo wants to answer a question about administered prices.
Yeah. Okay, so the new DG will do the statement of encouragement in the form of a hug. I'll speak to GFECRA and maybe the admin prices too, if you like, and something else. So on the GFECRA question, yeah, it'll create liquidity. So there's 150 billion that's going to be paid out to Treasury, 100, 25 this year, next year, year after that. And then there's 100 billion that goes to the SARB. The 100 billion that goes to the SARB into our equity, that creates no liquidity. That just moves around in the balance sheet from being a liability to being equity. The 150 billion, which we'll do 100 this year, we're not selling any foreign exchange reserves. And if we're not going to sell foreign exchange reserves, then something else has got to finance them. And that something is now going to be central bank debt. So our balance sheet ends up looking a heck of a lot more like other EMs, which have a lot of central bank debt and some central bank equity financing a lot of foreign exchange reserves. Our assets are almost exclusively foreign exchange reserves. The form that debt will take is going to be largely excess reserves, so bank reserves, which is a component of M0. And that's because of the nature of our monetary policy implementation framework. We run a surplus system, we pay interest on excess reserves, and we provide banks with what we call quotas, where they can deposit the cash back at us and earn repo. We have the quotas just to force banks to still trade with each other a bit. We don't run a pure floor system. So most of the money is going to go into larger quotas and be remunerated at repo. I think we'll drain a little bit of it with using some other tools just to make it nice and smooth. And we hope that the transition will look quite a lot like the transition we did almost exactly a year ago, when Treasury took another pot of cash they had deposited at the SARB, which is the National Treasury Sterilization Deposit Account. It also expanded the money market surplus. We also expanded quotas. And we saw very small to no movements in things like benchmark rates, interbank rates, when we did that. This is a larger amount of money. But we did a survey of bank treasuries, of all the bank treasuries on the SAMOS system. And that survey I found very encouraging. There was a large degree of consensus that the system can handle this and that we should see only modest changes in financial conditions as a result of this. I think we're going to be able to adjust quotas and tweak things so that there are minimal inflation impacts and sort of real economy impacts out of this. You might get a few variables move around a little bit, maybe a little bit demand for T-bills or something like that. But I think on the whole, banks already have excess liquidity and they're happy with the portfolios they run. So giving them even more excess liquidity probably doesn't change their decisions in a material way. Just to speak to admin prices and Crystal's question, this often comes up, and it came up a lot in 2017, 18, 19 when we moved from a de facto target of about 599 to 4.5. And I think there are two answers to how it might behave this time around. The one thing is the thing that we saw last time. Everyone said these admin prices are so sticky. How on earth are you going to get low inflation if you've got these high admin prices? And it turned out admin prices could go down. Probably what's going on is admin price setters think about the real increase they want. In other words, the increase adjusted for inflation. So they start off saying, well, I want a 4% increase plus inflation, so then that gets them to 10. Then you deliver lower inflation, and they say, well, I want a 4% increase adjusted for inflation. And if inflation's lower, that's a lower number. So two separate groups of people have been working on this, and they sent me their numbers, and they actually came to almost exactly the same number, that the decrease in admin prices from before the disinflation to after the disinflation was almost exactly equal to the size of the disinflation. So the size of the disinflation was about 1.5 percentage points, and the estimates were somewhere between 1.5 to 1.7. So you could get that. The other thing you could get is what Honohan and Orphanides recommended in their review paper, which was to get the buy-in of government, of the admin price setters, to help you disinflate. And if those prices then come down, that makes it much easier for you to get an overall lower rate of inflation. It would be essentially a positive supply shock. So I can see two ways in which admin prices could support a lower inflation rate. I think either of them could work. Thanks.
Rashad, you want to add?
I want to add one thing on. Actually, David covered the admin prices adequately, so as he did the other. But I think that it's important for the public to realize that there's nothing special about JFECRA transfers. That when you have, in modern central banking, when you have a balance sheet where the asset side is more active, so when you increase the asset side of your balance sheet, you're adding liquidity to the economy. When the liability side of the balance sheet, like notes and coins, reserves increase, you are draining liquidity from the economy. So whether we do a JFECRA transfer, whether we buy more foreign exchange, whether we do what we did in COVID, bought 30 billion rand or something of that magnitude worth of bonds, an important part of the SARB is to kind of insulate those activities from monetary policy, because they could lead to inflation, and the way we do that is, as David put it, we sterilize it. So it's a number of channels or a number of activities in this asset side of the central bank balance sheet, of which JFECRA is one, and a few others need us to do what David outlined. Thanks.
Okay. Fundi, why has he disappeared?
Governor, I'm here.
Yeah.
Okay. So on grey listing, we haven't seen anything on the banking side. Banks have been managing to maintain their correspondent banking relationships and remain intact. Where we have seen changes and impacts relates to the equivalence that JSE Clear has. Firstly, in the EU, because in the EU we were allowed a level of equivalence, meaning that we didn't have to make any additional changes to our rules. So we were recognized in the same way that EU clearinghouses were recognized in the EU. The EU then moved us onto their blacklist, which meant that we lost that level of equivalence. The UK has then followed suit in terms of clearing, this clearing status of JSE Clear. But what we haven't seen in the UK, because already there are South African entities and South African financial institutions that have got other clearing relationships in the UK. So that has not negatively impacted our trading relationships as we have it. When it comes to credit rating agencies, there's also no negative impact. The real test will come ourselves in the unfortunate position of not being removed from the grey list. If we're not removed from the grey list, that's when the consequences would start to kick in. But that's not the scenario that we're working on as things stand, because the work and the feedback that we've had from FATF at present is suggesting that we are broadly on track. We are reporting to FATF again now during May, starting with the joint group meeting, and then we'll go to the main FATF meeting. So I think in that regard, we just need to assess where we're going to find ourselves around September, November. Thanks, Governor. Back to you.
Thank you. I think, put simply, the issue of us coming off the grey listing is firmly within our control. It's the things we do to get out. There is no one who is forcing us and keeping us in the grey list. We know that there are steps we must take to come out of the grey list, and we should. I think that, David, you did a good job with the admin prices, but the question was whether we are moving to structurally higher interest rates. If you want structurally higher interest rates, target 8%. Then you will have structurally higher interest rates. Higher inflation begets higher interest rates. If you want lower interest rates, you must have lower inflation. So if we want to move to structurally lower interest rates, we must move to structurally lower inflation. It's as simple as that. And James say, what word of encouragement can we give South Africans? You know, I wish I could, but I am not a peddler of hope. My job is to tell it as is and say, these are the numbers, and I can say to you that inflation has turned out to be higher than what we expected it to be this time last year. And what I could say is that it had proved the correctness of the policy positions that we had taken to rein in inflation and protect the buying power of South Africans. And if South Africans are losing sleep about high prices, I think that what we can say to them is there is an institution that has made it its business to rein in inflation, and that institution is the South African Reserve Bank.
Good evening, Governor and the committee. This is Tumi Budigelo from Nedbank Private Wealth. A simple question on my side. Just wanted to find out, has the conflict that's happening currently in the Middle East and in the Ukraine and the potential one coming out from China and Taiwan been factored into your forecast of inflation and the impact on the oil prices and possibly the shipping costs?
Hi, Governor. This is a question from Asanda Koyo on YouTube. Has the South African Reserve Bank collaborated with other SADC member states, regional institutions, to harmonize monetary policy frameworks within the region to enhance the effectiveness of the SADC RTGS system?
Is that it from online?
There is another question.
Yes, this time from Facebook.
Also from YouTube, from Siphelele Mdudu. If you were surprised by inflation moving up higher than your own forecasts, are you not expecting a surprise to the downside now?
Is that it? Okay. Going, gone. Okay. To me, the geopolitics are very difficult to analyze. The beauty of being an accountant is that there are accounting standards, so we can check that the way in which you are approaching accounting, you are adhering to the standards. And if you are an economist and you publish an article, we will say you must be subjected to a peer review. Anybody can emerge on radio and call themselves a political analyst. And that is the problem that we are having. So it becomes difficult to analyze this stuff. And so in 2022, at the spring meetings of the IMF, people worked out scenarios and they said Russia invading Ukraine, 3 scenarios, a short war, a medium one, and a long war. And I said, what is the long war? And said the long war is 12 months. We are past 24 months and ticking. And there is no sight of the end to the war. So it becomes difficult. And so David and I were busy talking to the investors last week in Washington, and in one of almost our penultimate, we engaged then, we are talking about this geopolitics and so forth, and somebody says, Israel has just attacked Iran. And the conversation at the dinner table changes immediately, and nobody wants to talk economics, they want to talk about that. So this geopolitics generate a lot of uncertainty. And it's difficult, even for us as economists, to factor these things in. And so you end up just taking things as they come along. So no one thought initially that this geopolitics would affect shipping traffic in the Red Sea. Okay, but maybe it's because as human beings we also forget. The reason why the Portuguese explorers tried to find a route around the Cape was precisely the problems in the Red Sea. It's centuries old, okay? So it's just recurred, but it's a centuries old problem. Now the thing is that add to all of those uncertainty about the politics, then there is drought that has affected water levels in the Panama Canal and making shipping expensive. So you have got 2 things that are fitting themselves into shipping costs. The day that Israel attacked Iran or retaliated against Iran, the oil price jumped. I think Chris showed the slide. We moved from like $86 to $90 a barrel. It's a forecaster's nightmare. And so when somebody says that you got your forecast so wrong, understand that there are all those parts all moving at the same time, and which then makes the best forecaster to be the one who is less wrong than the others, not the most accurate. You just had less wrong than the others. Sipela and I talked about the surprise to the downside. If there was to be a surprise to the downside on inflation, it will be very welcome, because that would mean that there is relief coming for us. SADC collaboration on harmonization of monetary policies. You can't harmonize monetary policies unless you have got macroeconomic convergence. And so SADC committed to a program of macroeconomic convergence that included inflation, debt to GDP, fiscal deficit to GDP, and lots, and said that this is the convergence program that if all countries go for these variables, interest rates will begin to harmonize. You can then talk about harmonized or aligned monetary policy frameworks. Entered COVID, there is more divergence than there is convergence, which means that harmonization is pushed down the line. If I may say that when we meet as SADC central bankers, and we meet at least twice a year, we do an assessment of where we are with the convergence program. And over the years, the sad reality had been that it had been bar 2 countries, the areas where the central banks are responsible for the convergence is taking place. And the ones where the treasuries are responsible for the convergence, there is more divergence. And just almost like similar to what you would have seen in Europe, there aren't sufficient countries who would be able to tell the big countries, you are messing the neighborhood. And so when the deviation from convergence in Europe is from the major countries, there isn't enough people or countries to say to the big countries, you are messing the neighborhood. It's very similar in SADC. Thank you very much. The MPR will be available outside. Do take a copy, and do also join us for refreshments, and I'm sure conversations can continue. If you have got more difficult questions, there isn't a shortage of people from the Reserve Bank with answers.